Good morning and welcome back to Almus Market Mornings. It seems the word transitory is back. While the Fed kept the policy rates unchanged, there was specific use of the word transitory while describing tariff induced inflation. Stocks moved higher and the bond yields moved lower after the Fed meeting, despite the reduction in growth forecast and projected higher inflation over and above the reduction in the pace of QT starting April. Good morning, JK. BOJ and Fed meeting just concluded. What were your key takeaways? Was the Fed dovish in its statement? What's your take?
Yeah, good morning, Swaraj. Yes, I think the Fed statement was least hawkish and I would say on the margin somewhat dovish. And that's something that the market took with both hands. Uh, so the key takeaway obviously has been what Powell stated about inflation being transitory, which is induced by the tariffs. So they think the impact would be for a limited period, and it will, no, it will then diminish. So otherwise, while the market had not expected any change in the rates, the focus was always on how the Fed forecasts are going to be called the summary of economic projections. So there was some cause for concern because growth has been downgraded from 2.1% to 1.7% in 2025. And the unemployment rate is projected now at 4.4% versus 4.3% earlier. And more concerning is the inflation forecast being raised 0.7% from 2.5%. You get a sense that they are also projecting a stagflationary situation if this is how it is going to pan out. On the rates, the projection is that there will be two rate cuts, which was what even earlier the dot plot conveyed. But I would say the most comforting factor for the market, which took the outcome quite positively, was uh, you know, uh, Powell saying that they would be cutting the QT monthly cap from 25 billion to 5 billion. This is almost removing the quantitative tightening that leaves a lot of liquidity in the market, and this will also leave the yields lower. In fact, yields have reacted quite a bit. 30-year and 10-year dropped by 10 basis points, 2-year dropped by a whopping 13 basis points. And this is exactly what Fed and the government, or more of the government wants, because they want to lower the borrowing cost for the huge borrowing that they have kept. And of course, Powell also said at present there is unusually elevated situation of uncertainty because of the government policies. And to a question that whether there will be a a rate cut in May, he said that we are not going to be in any hurry to cut the rates, as far as the future meetings are concerned. But I don't think market was expecting anything different from him. If you look at the market expectations now, Fed was to show still three rate cuts by the end of the year. First rate cut coming in May, for which there is a probability of 60%. The markets took, as I said, with both hands. Dow rallied almost 1%, S&P 1.08%, Nasdaq 1.41%. Yields were lower, which means bonds have been rallying. Gold higher into a new all-time high. And the dollar itself was, somewhat on the weaker side compared to where it was just prior to the meeting. Now, earlier in the day, as I said, Bank of Japan also kept their interest rate steady on Wednesday, underscoring policymakers' preference to spend more time gauging how the mounting global economic risk from US tariffs could impact the Japan's fragile recovery. The governor failed to commit to any terminal rate, and he said it depends on a number of variables, and BOJ will alter policy according to economic data. So that again was almost as expected, although yen weakened beyond 150 after that. But the direction of yen changed after the FOMC because the yields falling so much, yen could not be weaker anymore. So we saw the yen almost falling to 148 from 150 that was seen earlier in the day. Euro was seeing some profit taking and gone as low as 1.0865, then again back above 1.09 now. And of course, other currencies have not seen much of a movement because in one way or the other countries are looking at how the tariffs will play out. So the key date still remains the April 2nd. by when we will have much clarity on what the tariffs are going to be like and who will be affected most, and whether there will be reciprocal tariffs, how it is going to impact the markets and all that. Uh, so I think this FOMC impact is like almost done. So market will now look forward to the data, hard numbers from the US, to see whether growth further slows down, and whether it tilts Fed's thinking more towards supporting growth than on inflation, because in any case, inflation is being seen as transitory if it is driven by tariff. Therefore, weaker data going forward means dollar will be more weak. That's the key takeaway. And yes, I think euro already supported due to the various fiscal measures envisaged in Germany and other countries in Europe, is very well supported. And yen, of course, will definitely be stronger, because there is expectation that the next meeting will see a rate hike, and also the yields lower we in US will also push the USD and down. GBP remains somewhat sidelined ahead of the MPC rate decision tonight, which is not expected to give much of a. So broadly, GBP will take its cues from the overall dollar direction. Now on the rupee, there's been one-way strengthening direction that the currency has taken, which has surprised some in the markets, because for several months we've been used to seeing its weakness, notwithstanding whatever else is happening in the global markets. But our followers should recall that we have been hinting at the year-end related flows that can strengthen the rupee. Few additional factors have also come in: slowdown in FII outflows, sharp fall in the dollar index, and the stability in the local market in this stock index that has been seen. One additional factor that the market hinted yesterday was the reported direction from the regulator to the banks to unwind their forward long positions in the NDF market. This would have brought in a lot of market dollar selling into the market, and whenever there is such a direction from the regulator, banks don't wait to execute, and those unwinding would have also helped the rupee break the key 86.50 level, which I did not expect, at least. But yes, what also was significant was that the central bank continued to absorb these selling, and right now the market is looking at around 86.30, 86.20 as a support. One more factor that could play in favor of the rupee has been what is stated in the RBI bulletin published yesterday for the month of February, where the RER is now noted at 102.37, a big drop from 480 that was reported in the previous report as on 31st January 2025. This again gives a sense that rupee is not so overvalued as it was earlier, prompting shorting of the rupee in the market. What now? Fed's dovish message is depressing the overall dollar index lower, with most currencies seeing gains, but dollar index is still hovering above the strong supported 103.25.30 region. Besides, RBI would most likely absorb any large selling in the market and keep the rupee from appreciating too far. Technically, I see strong support coming at 86.25. If the dollar index were to break down further, then you can see a fall to a more important support at 85.85. And generally, I expect the former level, I mean the 86.25 level, to hold because of the April 2 deadline for tariffs, so which will hang over the market. And only if the dollar index breaks down, we see for the move in the dollar rupee. But overall message is the dollar will remain weak both against the major currencies and the EM currencies, including INR. But the moves will be restricted until we get clearer picture about the US policies. Thank you.
Thank you, JK. And just quickly summarizing, when it comes to the Fed meeting, the key takeaway was that Chairman Powell stated tariffs impact would be transitory. And when it comes to a summary of economic projections, growth has been downgraded. There is higher unemployment expected, while even inflation forecast was raised. So a stagflationary situation was projected, dot plot indicating 2 rate cuts in 2025, while markets are projecting 3 rate cuts as per the Fed Watch tool. The QT monthly cap is cut from $25 billion a month to $5 billion a month. Yields move lower after this update. This is a big plus for the administration, which is trying to reduce the borrowing costs. And the market reaction was equities rallied, bond yields were lower, and gold at all-time highs. When it comes to rupee, one-way strengthening has been seen in the rupee. Fall in dollar index, limited FI outflows, and the long unwinding, which JK mentioned, has been driving rupee stronger. REER saw a big drop, so overvaluation has reduced, which is reducing the sell rupee narrative, which is keeping the sell rupee narrative limited. But the cues to look at would be the fall in dollar index and whether it continues from here on. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.